opinions.
And Billy Bailey with Saltstone Capital. Excited to have him on this panel, as well as John Durand with XRI. So, gentlemen, take it away.
Aaron, thank you very much. I always have opinions. Sometimes they're even close to right, but it's only sometimes. We've listened to a lot of companies talk about the technology that we are deploying in the industry today and how ESG plays into it, whether you're pitching an oil company or pitching investors and playing off that. And that's very helpful. And the slides were excellent. And the fact they were so good, we're not going to do slides. We're just going to talk to you this afternoon. But this is going to be more interactive because John Durand, who is on the far end, is the president and chief sustainability officer of his company. So he's in charge of ESG, and he's gotten very active in the industry on several different committees and boards on ESG. And he's an operating company. And Billy Bailey, who I've known for years as a portfolio manager, used to run money for Boone Pickens, so he knows what he's doing in the energy business. And he makes investments in the business. And so while we've had excellent technologies, and some of them are amazing, and the future of our business, how that impacts other parts of the business is something we want to talk about. And obviously that's capital. I realize a lot of the people in here would love to raise more capital. I know I would love to have more capital personally. My wife won't give me any more money, so that's just the way it works. And so these guys have an interesting perspective. And because it's a small room, if anybody has any questions, if you'll raise your hand, I promise we'll get a question asked. John, let me start with you. You run a company, XRI. You're a water company, so there's all sorts of different ways you can play on ESG. You've said before that you're a different kind of company. And when it comes to, well, in general, I'll let you do that. How are you a different kind of water company today?
Well, thanks, Jim, and thanks to EnerCom and for everybody here for being here. It's a pleasure to be here. I guess, Jim, we're a different kind of company because a lot of our peer companies in the water midstream space, which really came about formally under that terminology in the last 4 or 5 years. XRI, we're backed by Morgan Stanley Energy Partners. We've been with them since 2016. The company was actually formed in 2013. And what was really different about us is our founders came from outside of energy. And by doing that, they came with a very new and different paradigm. They came out to West Texas and they saw a desert. And they were told that there's, well, you know, it gets worse. There's droughts out here. And my comment has always been, I never know when there's a drought in West Texas because it always looks the same to me. However, but what sets us apart, I guess, from a lot of our peer companies is we started with the foundational belief that there was a better way to do things. And in 2013, the better way to do things was to not utilize fresh water. And we actually, I was with Pioneer, actually, helping them start up Pioneer Water Management, which has been a phenomenal success for what they've done there to integrate into their large scale in the Midland Basin. So I was actually a customer of XRI's, and one of the reasons that I think we've been successful is that we really came in with the mindset of weaning the industry off of fresh water early. So that idea of sustainability, Jim, really started at our foundation, and we've only, which we can talk about here in a bit in some more detail, but we've only then continued that path with a focus on treatment and recycle. We don't currently operate any disposal wells. We have partnerships with some of our operators if we ever need to use disposal wells, but quite frankly, we view disposal as a creature of last resort for produced water.
So you weren't doing it for the good of the country at the time. You were doing it as a way to see a business that you could develop and grow.
That's exactly right. And again, we had a lot of people just say, you know, we're fine with fresh water, or we're tied to certain landowners that have us kind of locked up. So we had to patiently wait a while with certain customers. Some immediately embraced us. We found out the difference, and we knew the difference coming in. Drilling non-potable Santa Rosa wells typically was was the horizon that we were drilling these brackish non-potable wells, and so they were more expensive. So some of the early movers in terms of customers for us were some of the same customers we've got today. They're the large, majors, they're the super independents, they're the folks that now today are very driven by ESG initiatives and sustainability initiatives.
Billy, you got the money. You get to dole it out to everybody. And when companies, say, gosh, we have an ESG program, or we don't have an ESG program, do you care?
It's a great question. So first, it is really great to be in person. Thankful for EnerCom for hosting this. Aaron and I were actually just talking. It was a little over a year and a quarter ago when we were at a Haynes and Boone seminar that they were hosting, and then prior to that, it was also EnerCom Dallas. So it is good to be back in person. I didn't know what to do coming up the elevator with the mask on, but it is good to see a lot of familiar faces, and grateful for the opportunity to be here, and thankful for EnerCom for the good work you do. Y'all were one of the first conferences I ever attended. August of 2010, I just got in a full-time offer from Boone Pickens and had just finished my internship. So grateful to be here in front of you and speaking in front of you. So just to your question on ESG and allocating capital, I might have a little varied opinion in terms of what's transpiring in the landscape. And I think it's critical to understand every single person and the background and what they're fixated on. So for myself, we're equity investors, public equity investors. And while ESG is definitely a massive theme, which you only need to look at BlackRock's annual letter where they focused on the net zero and what they talked about as $300 billion of capital going into ESG investments, an increase of $300 billion of capital in 2020. That's just for the first 10 months of 2020. So it's a 2X over what transpired in 2019. Climate Action 100 plus, there's $54 trillion of global assets that have signed up to essentially promote the need for companies to wean themselves off of fossil fuels. So where do we sit in this dynamic from fossil fuels? Where do we sit in this paradigm? I think it is critical for us to educate people and to continue to educate that we are going to be the bridge for the future. We all see where the puck is going. ESG is going to be vital, but at the same time, we're going to play a crucial role in that. So when assessing companies, it depends upon your time horizon in which you're investing, as you know very well. It depends upon what you're focused on. But if you look at last year as a microcosm for many different, small cycles that transpired within energy, you had the COVID rollover, equities, energy equities, traditional equities got demolished. And then you had, where we thought that because of stimulus, et cetera, from mid-March to mid-June, you had a massive ramp up in equity valuations. You saw them starting to trough off of the lows, and then they performed really well, and then you traded back off again, and then you look at what transpired over the last 6 months, post-Pfizer announcement November the 9th of 2020, energy equities have doubled. The XOP has doubled. And so when you look at it in that landscape, I have heard a lot of management teams discuss that, well, it's just this ESG stuff that is causing us not to perform well. And I think if we look at it realistically, we peel back, we are so fixated on the environmental aspect of that acronym and not so focused on the social and the governance aspect that we have to look at what we can control. And the only thing that we can control and what investors have been pushing at the hardest is the G, and the governance. And so if you look at the last 6.5 years, we have been in a terrible, atrocious bear market. I launched a fund. I spun out on my own in 2016, and not only is it a hedge fund, but it's also an energy-focused hedge fund. It's like the two worst things you could possibly be doing. But at the same time, you look at what we need to be fixated on, and it is how can we drive free cash flow yield? How can we drive return on invested capital? How can we drive return on capital employed? And those are going to be the things that are going to be driven by the S and the G. And then if you look at the E, that's only going to incentivize more revenue, more top line, right? So if you're not flaring, if you don't have emissions, like that's going to drive a healthier, better company. But at the end of the day, if we're realistic with ourselves, and BlackRock states that 88% of their correspondents within their letter that they sent out say that they're focused on that E. So if we only know that we can really drive the S and the G, we have to do that really, really, really well. And I think that's what we're focused on, and that's what we're studying. So I hope that provides some insights into how we think.
No, it does. That's actually very helpful. We always think of the E as a cost.
Right.
For years, we've thought of it. If somebody says, well, there's this environmental issue, the first reaction as an operating guy, which I used to be once, was how much more is that going to cost me? Mm-hmm. And we didn't know, and societal was we weren't sure what that is. That's already been changed by the U.S. Business Council. It's no longer shareholders, it's stakeholders to embrace a larger range of people.
Milton Friedman wouldn't be too happy.
No, no, he wouldn't. But in the international oil business, which is where I spent most of my career in the oil business, we were used to building schools and houses and roads and different things for people. So the international end of the business always had the societal right. And then, like I say, the governance, there's been over, 600 energy-related bankruptcies in the last 6 years? That's an awful lot of board members who may not have been paying full attention. So that, John, that leads me, you got the E down pat. You are reusing water. You're not disposing of it. You don't own disposal wells, and you're working on the E. Tell me about the S and G. What do you do about the S and the G in a position? You're private. What do you care?
Well, we're private today. That may not be the case in the future. But the reality is we've got to, as a midstream services company, we absolutely have to cater to what the needs and the initiatives of our customers are, and that's what drives us. So we as a private company certainly care about community engagement, community involvement. We certainly run our company ethically, but we're not a public company, so we're not under that same scrutiny and under that same spotlight that a public company would be. But in order for us to serve the customer base that we have, and they're the largest companies, largest operators in the Permian, and getting larger through consolidation, we absolutely have to care about all aspects we have to care about the S and the G, and we do it in our way as a private company, but certainly as the initiatives evolve for our customers, we're going to evolve with those.
If you don't care about ESG, can you work for Exxon and Chevron and Shell?
No, you're gonna force me to brag about my safety record, but in a word, no.
Okay.
We absolutely cannot. We're seeing that firsthand because we are part of water is part of the upstream. I spent a great deal of my career working in the conventional midstream. Mm-hmm. Loved it to death, learned a lot of great lessons, both private and public companies. Saw the opportunity to get into water and potentially transform that into a midstream model that made sense for the industry, made sense for the environment, and for the communities that we work in and live in. And so, again, Jim, it's just imperative that we focus on all aspects of ESG, because without it, it's going to be a tough road for a lot of our peer companies, whether we're talking about midstream companies, conventional water, whether we're talking about oilfield services companies. It doesn't matter. You've got to, for the right reasons, embrace these initiatives of our customers.
That's one of the concerns of mine is that I know a lot of smaller oil service companies that say, well, we're not big enough to have an ESG program, so it doesn't matter. When they need us, they'll hire us. And I just don't think that they realize that you're going to have a bunch of small companies fighting for the smallest, lowest end of the E&P food chain with that kind of opinion, and they're going to be horribly left behind.
Yeah, well, they'll be consolidated out.
Yeah,
for sure.
Okay. And Billy, one of the things that you said really resonates with me, that the S&G part, the bottom line for investors is actually return on invested capital. This industry has operated for a very long time on cash flow, and I've had a business before, and nothing's more important keeping the lights on than cash flow, right? You don't have cash flow, nobody gets paid, nothing happens. Okay. But it's interesting to me that we have not until very recently started to focus on actual return on invested capital. And we make the note to people on occasion that if you're an owner of your business, for every year you don't earn your cost of capital, the value of your ownership in the company goes down. And while we all hope for spikes in oil prices so the values of our businesses and stocks will go up, how many people here sold at the last peak? How about the people who sold at the peak before that? Not a lot of hands. And it always strikes me that the only people, Billy, who benefit from spikes in oil prices are the more shorter-term investors than the people in the industry who don't get the chance to sell like that. And so the more positive outcome for the industry may be at the expense of those short-term hedge funds, not you.
Now you're going to really fire me.
Is that the whole industry becomes a more profitable industry and expands equity value without hoping for price spikes. Is that something sane?
So I'm thankful to have a lot of great relationships in the energy space, and it is the best sector you could possibly, invest in, just from the standpoint of the people that you get to surround yourself with. But I think we all have to be incredibly transparent and realistic about what has transpired since the June of 2014 when the XOP peaked, is that in reality, the only people that have made money are the C-suite of publicly traded companies. And if you look at the salaries and the bonuses of cash that has been flowing out of the businesses to these executives, those have been the people that have made the money. Yeah. And so I think that, and I'm a public equity investor, so I want to make sure you all know the lens in which I'm speaking through, because that has been a very big point of contention to me. I mean, there have been several instances where I've seen a company and seen how it's been managed and how it's been stewarded and those assets of investors that have placed capital within those businesses. And I would have simply raised my hand to take $10 million of cash every single year to bleed 60% shareholder returns by stock depreciation since June of 2014. So that goes back to fixating on the governance aspect of the business. And as long as businesses are tied towards just growing production, and in the fact that we went from 5 million barrels a day of production to 10 million barrels a day, an incredible feat, which, by the way, I know I've transitioned to a larger topic, but we essentially stimulated the whole tech boom off of cheap energy, which a lot of people don't talk about. Facebook, Amazon, Netflix, Google. I mean, you look at that, we were the ones that allowed for that. They're actually together the third largest user of energy globally, behind only the United States and China. So if you just look at their cost of goods sold and you look at if they'd actually been expensive on a kilowatt hour basis, then those companies would not be skyrocketing. We would not be declining. We have done this to ourselves. And a lot of that just goes back to governance. It goes back to shareholder alignment, and it goes back to what management teams have been paid to do, and they've been paid to grow. And now that you're seeing this reversion because of investors, because of, everybody likes to hate on hedge fund investors. Well, guess what? There are a lot of hedge fund investors that are in the room talking to C-suite executives saying, look, I can't raise any capital right now. And if everybody's shrinking my management fee and shrinking my performance allocation, and we can't generate returns for our investors, well, guess what? You no longer deserve to get paid a couple of $1 million of cash a year to be able to have a stock that goes down 60%. We need to be aligned. All of us need to be aligned. And as soon as we all work together and understand where we're trying to get to the end road, then guess what? People will start to invest in the space again. You'll see free cash flow. It'll be just like the way I've been describing it is that we have been commingling the mid-'80s to late 80s to the late 90s, right? You've kind of had both of those cycles blended together, and that's what's created what's transpiring today. And then on top of that, from a macro perspective, you have this ESG aspect that's filtering into it, and a lot of people have avoided, thankfully for their investors' capital, avoided energy over the last 6.5 years because it hasn't generated an iota of return.
No.
So I hope that kind of answers a little bit of...
It does.
And no offense to any of the publicly traded CEOs that are listening, because I do love you all, but we got to all have the conversation.
You're all overpaid, but we're not going to mention that in public. Oh, wait, we just did. No, it amazes me. There's 153 oilfield service bankruptcies, and if you are the CEO and your company goes bankrupt, coming out of bankruptcy, you're going to be worth more than you were for the last couple of years before you went in. And if it's because of macro issues that caused you to go into bankruptcy, I understand. And if it was your stewardship that caused them to go into bankruptcy, that's just criminal. And
can I just add one point to that?
Go right ahead.
I would love to see a restructuring of C-suite compensation packages that they would be willing to take a massive cut in the cash out of the business in exchange for shares in the company. If I'm going to own shares, I want my executives to own shares. I want the pain to be there when the stock, when I'm looking at the screen and a stock's going down 80% or 90% or 95% are bankrupt. I would like for the CEO that's sitting there to recognize that, you know, you're not okay. It's not okay. Like, we need to fix this.
Yeah.
That's
So
a
the
great
CEO
point, Billy. They
Yeah.
need to be sweating along with the rest of us.
Yes.
It's a great point.
I had one CEO of a large oil field service company tell me, he goes, but Jim, my compensation is already based on stock price performance. Yes, the $2 million of your $19 million in comp is based on
Yeah.
stock performance.
Yes.
Maybe we switch that around. He said no. John, you're a public company, a private company. You've been growing. You've had need for capital. Does an ESG program impact your cost of capital in any way or access to capital in any way?
Well, it absolutely does. Again, you know, Morgan Stanley is our capital provider, Morgan Stanley Energy Partners. And so at the very, you know, their parent, Morgan Stanley, I mean, they're certainly very focused on investments across the board that are very sustainable. You know, they've got, I believe it's called the Institute for Sustainable Investment that Morgan Stanley's implemented throughout the company. So it's very critical. And when we, you know, we were privately funded until 2016, from 2013 to 16, when Morgan Stanley became our partner. And as we've grown our business and focused on the things that now are, you know, the reason we're having this conference today is to talk about ESG and the impact it does have on the industry. And as Billy pointed out, the importance of us communicating effectively and honestly how good we are at what we're doing and being transparent about saying, this is where we're going to be better. And oh, by the way, we're going to prove it because we're going to start measuring it. Morgan Stanley looks at us and they're great because they're conservative. You know,
That's good.
I love that conservatism because it aligns with the rest of our management team. It aligns with the way that we've grown, which has been primarily organically. And you can do that when you have the opportunity to pick the customers that you know are going to be there at the end, which was probably one of the best things we could have done early on in our history. It's not that we discriminate. We just want to make sure we're partnering with folks that are going to be there and adding value to their business, and in turn they add value to ours. So bottom line is we are just naturally, because of the nature of our business, have a bent towards sustainability. But it's incredibly important whether we remain with Morgan Stanley for the next 10 years, which would not be unprecedented. They're that patient of investor, and you know, they'll look at us and say, you know, we love what you're doing. Just continue. We'll pay distributions to our LPs. Our LPs love what you're doing. We can do that, which is very different from a lot of private equity companies that are not necessarily as patient.
It's called having a silver spoon. Congratulations.
Well, thank you. I wish I could take more credit for that, but our CEO, who I give credit for, you know, it's all about, rather than being a team with a dream and going out there and cutting a deal, is building a company in the right direction, and then you go, and then you're not out there begging for a sugar daddy. You're actually, people are bidding to be your capital partner, which made all the difference in the world.
Over promotion in an oil deal? Really? Stunning.
Never heard of that.
Credit Suisse did a study last year that showed consistently that companies with an ESG or sustainability program had consistently lower costs of capital and more access to capital. Fitch, one of the leading rating agencies, now includes their ESG initiative as one of the top 6 issues in their lending profile. We mentioned return on invested capital. The best way to get a return on invested capital is get a really high margin and lower your cost of capital. And so if you do both in conjunction, you win. So keep in mind that the access to capital overall to everybody in this room, because we are in oil and gas, has become significantly limited. Maria, who runs E&P lending for Bank of Oklahoma, said that a year ago there were 50 banks who would loan. Today there are 25. And so capital sources across the board, Vanguard, Wellington, household names and investments, no longer have energy specialists on their teams. Fidelity had the head of energy who had been there for 20 some odd years. He got let go last year because there wasn't enough to play, energy stocks to play in to matter. And I agree with Billy that once we start demonstrating our ESG capability, John, and our ability to generate a positive return on invested capital, investors will come back. But to expect them to come back to an industry that they view as unsustainable and one that hasn't earned money in years is asking a great deal. And so it's going to be one of those where we have to change our behavior before the behavior toward us has changed.
Yes.
John, you hit on one thing that really struck me, that you cater to the needs and initiatives of your customers. And it just strikes me that that's the term for alignment. Mm-hmm. And while we've had a period of alignment, I think through 16 and 17, and it died in about June of 19 when oil prices died again and every E&P company said, screw partnerships, give me your lowest price. Do you see the kind of alignment that you mentioned here between service companies and E&P companies improving over the next couple of years? And does the ESG idea help that?
I think it absolutely helps that because, again, as we touched on previously, you've got to take ESG serious. Certainly as a service company, it's imperative that you do that. It's imperative that you prove that. And I will say this, 2020 ended up being a landmark year for us in a very amazing way. You know, in 2019, there was a lot of, end of 2019, there was a lot of momentum behind the idea of treatment and recycle. Right. It was just a matter of, is it economic? Is it on par with what you can do with produced water versus just taking it and injecting it downhole? A lot of momentum building for us as we started to integrate that acquisition that we made in 2019 of Fountain Quail, which is a treatment and recycle company that's been around since 2004, since the Barnett Shale. But again, recycling, you know, operators didn't know what water they wanted, what quality spec they wanted to recycle to. So that was an issue. And that's one thing that kept costs so high. But when we came out of, you know, the shock of COVID and the shock of the impasse that created the fallout between Saudi and Russia and the fallout of the oil price, we came into incredible alignment with our upstream partners because they then said, okay, in our example, XRI, we love that you're giving us non-potable water and have been doing that for 6-7 years. Now I want all the produced water that I can get. I don't care if it's my produced water back, treated for my reuse, or someone else's. So that alignment, again, with that ESG thread tying us all together, is certainly going to be a big part of the future going forward.
That's critical.
Can I touch on your comment regarding what's transpiring in the space in terms of the dearth of capital that's being allocated to the sector?
You bet.
So one thing to that front is in 2016, so Feb of 2016, when crude touched 26.05 and hit the low, from mid-June of 2014 till the end of 2015, there was $150 billion of debt raised and $150 billion of equity raised to allocate capital to what investors thought was going to be the reincarnation of the great financial crisis when energy prices quickly went from 30 back to $100 a barrel. Mm-hmm. What transpired was not that. And in fact, you saw an incineration of an abundance of cash that was put into the sector. And we're at a point now where the starvation of capital that's being allocated to the energy sector right now is actually, in a perverse way, very positive. It's positive because if you operate in a sector where global demand at best grows at 1.25%, then you cannot be growing your production in excess of 1.25%. And in fact, you have to have a free cash flow yield that is in excess of other sectors that are not operating in a highly cyclical business, because you have to incentivize investors to place dollars within your equity, and they have to be paid to in order to do so, because they're taking on inordinate amounts of risk. And so to me, I actually think that this is, for the first time in my career, one of the most exciting times to be investing in this space. And what I'm seeing is that the commodity actually looks like, and if we are all realistic and we love the space, and it's so fun to talk macro, supply, demand, and talk about Abdulaziz bin Salman making a smirk at the OPEC meeting and feeling bullish on things. But if we're realistic on it, what you need is a cycle, and our cycles have been minuscule, they've been miniature, and they've been driven because of an influx of capital that's been thrown at this idea of shale. And now that we've figured it out, we need to now generate a return on that capital that was invested, and that's where I think the industry is actually about to take off, and we're at a much healthier place today. It's been tough. I feel for all the jobs lost. I'm in it with you all. We're all in this together, but we're also going to be around. We're not going to go the way of coal, in my humble opinion.
Tobacco maybe, but not coal. So
But even tobacco, we're better off. We actually, if you look at it on a per capita basis, the increase in life expectancy, when you correlate it to the amount of usage on a per capita basis, is a positive correlation. You increase the amount of life that you live if you use more energy. Tobacco, when you freaking smoke more tobacco, you decline. We're in a better place than tobacco. That is not a fair assessment.
I'm taking the argument. I agree with you. Okay. We did a study of all 21 public E&P companies that were public from 2010 through 2011. Okay, that's the shale boom. That's where we transitioned from a gas shale business to an oil shale business. Over those 10 years, those 21 companies outspent cash flow 7 years in order to accelerate the realization of value. Y'all remember that? Over those 7 years, those 21 companies lost $100 billion in value. Oops. In addition, they lost $36 billion in net income. Okay? And so the idea that they're going to find a whole new class of investors who want to put money in again while we do that again, those investors are going to be very hard to find. So I think Billy makes some very good points. John, thank you very much. That's all very helpful. I'm going to help Aaron get back on track. Are there any questions out there?
Come on, there has to be something.
Nothing? Anybody away? Okay. Gentlemen, thank you very much.
Thank you
Appreciate
so
it. It was
much.
great.
Thank you.
Always fun. Good to meet you. Thank you so much.